Today, folks, as I've aged, as my net worth and portfolio has scaled, I've kind of become more passive, more conservative. I've focused more on wealth preservation as I've gotten more responsibilities in my life, as I consider my fiance's investments into part of my own in our diversity of investments. So we're not overly concentrated. And so many of you have asked me opinions about why I'm not buying this. Am I looking at more individual stocks? What am I doing as a whole? How does this play into my TFSA and my RRSP as a Canadian-oriented investor that is buying mostly US stocks? Now, this is a very fun conversation into my own personal finances. And though this isn't financial advice, I'm hoping you can learn something that you can apply to your own personal circumstance with your time horizon, your savings rates. All of this thing comes into play, which is why I can't tell you what's right for you, as so many of you I notice in the comments like to tell me what's right for me. So I want to break this down, take a look a little more in depthly into these holdings and why I focus more on ETFs today than I did in the past. Now, recently, I want to try and play the interest rate cut cycle that I think could lead to some excelled performance, which is why I've been starting to buy things like real estate ETFs, which a lot of people I know aren't exactly, that excited about because they've lacklustered in such performance over the years. But I'm sure as we walk through this and we take a look at my investment accounts, you'll kind of get a clerical idea of why this is more suitable for me. Now, first and foremost, taking a look at the overlapping ETFs and what the actual underlying stocks I hold are, because the reality is, even though I'm buying ETFs, I'm still holding individual stocks. I am just removing the management and making it more passive, like the S&P 500's VOO. It's a market cap weighted system. So I can take my attention and focus it on a handful of stocks that I might swing trade over a year. It kind of alleviates some of the stress and it makes me sleep just a lot easier at night. And considering my fiance owns a lot of tech companies as it is, I don't want to over concentrate my own portfolio with tech. Even though it could lead to outsized performance, it can also lead to more volatility and we don't truly know what the future holds. So I really like the idea of wealth preservation over necessarily just trying to excel gains like I used to in the past. Now, keep in mind, I still want excelled gains and I work on it in a more managed way. But still, if we take a look at the positioning today with the way my ETFs overlap, Microsoft, Nvidia, and Apple are my three largest positions, making up over 10% of my entire portfolio today, at least my stock portfolio, right? And I love that. That makes me feel really good because I like the continued tech exposure. But as we go down, we got Amazon, you got Royal Bank, some Canadian exposure, Meta, you've got Home Depot, some of these beautiful dividend stocks that I think are trading still at relative discounts because of the current market environment. You got AbbVie in here. You've got Cisco and Amgen and Chevron, some oil companies, Lockheed for some defensiveness, BlackRock's in there, Verizon, some telecom giants, Coca-Cola, Warren Buffett's favorites. You got UPS in there, Alphabet, and even Toronto Dominion Bank, making up about 30 to 30, probably about 1/3 of the entirety of my portfolio just sits within these stocks. And I'm trying to continue to diversify that in a way that makes sense. Because right now I've got about 21% in information and technology, 18% in financials, 11% in healthcare being my 50% of the sector weightings of my portfolio. But as interest rates start to get cut, I really want to focus on some of these sectors I don't have as much exposure to, being real estate and utilities, as I've mentioned. So that's why I've been focusing on VNQ and some of these real estate ETFs. And I kind of want to dive into that and firstly talk about these different ETFs, and then we'll see how their performance overlaps over the last 5 years, and then we'll see how they sit within my retirement accounts. But this is kind of my thinking, right? I like VOO as the end-all be-all investment that I think most people should be cost averaging into, and I always am buying this no matter whether it's up, whether it's down, and I even have a stock market emergency fund, so if this corrects by more than 10%, I will start doubling up my monthly contributions to how much I'm putting in here every month, because I just love this passively weighted system. And you can see that in here with Microsoft at 7.23%, I don't actually have that much exposure to Microsoft because I've kind of de-weighted it with these other ETFs. And honestly, I'd still prefer it this way. Now, when we talk about VNQ and the real estate ETF, this one has severely underperformed the market over the last 5 years. And that is largely to do with a lot of the economic conditions. But we can see during the time from 2020, when we came out of those rougher economic conditions before we got into the interest and inflation cycle, this absolutely performed so well. But interest rates just clobbered it. And when I look at the top holdings, I could play these individually if I wanted better performance, because a lot of people are buying things like Realty Income, which is great. There's a lot of good things in here like Public Storage, but that comes with a little bit more concentrated risk. And I'm not looking to get like Excel dividend performance. I'm looking to just take advantage of the sector's return to a lower interest rate environment. And I think that's going to lead to better returns than we've seen in the past. And only time will tell. Now, SCHD, I kind of see this as playing both sides of the fence here. This was a stock that did a great job at keeping up with the S&P 500 over its long term up till recently. Interest rates, the economic circumstances have really dragged a lot of these dividend stocks, and I think they will start to excel in a better interest rate environment. But I am primarily just holding this as a continued diversity into the lower half of the S&P 500 kind of stocks or your Dow Jones kind of stocks. It just gives me a little bit more diversity and lowers the upper weighted tech companies, and that's where you see things like Lockheed Martin and AbbVie and Home Depot make their way into that upper weighting of my portfolio, because you got to imagine Home Depot is a huge company in the S&P 500. So when I buy it and I get another extra 4% in SCHD, that's how it starts upper weighting into the portfolio. And same with things like Coca-Cola and some of these other stocks. So I still have a great place for SCHD. I think we're going to see some pretty good performance into the future. At least I'm excited and hoping that's what happens. But there's no guarantees. The past does not represent future returns. And probably one of the also worst performers, and a lot of people hate on this, which is why I don't core focus on Canadian stocks, is VDY. I really like VDY and the concentration that it gives me to the Canadian banks. It's one of the primary reasons that I own it. It keeps up with performance of the broader Canadian market ETFs. So I really do like this, and that's why I don't have to own a lot of it to get those upper weightings in Royal Bank and TD, which I think are some of the most superior and largest companies in Canada that I still think have some really great performance ahead of them, with especially stocks like TD, right? So I don't have to own as much of this to get some of these upper weighted stocks I really want in my portfolio in a very passive way. And if they start to underperform, they will get de-weighted out of these positionings. So I kind of like it that way, and that's why I've pick VDY over perhaps XDIV or some of these other, Canadian dividend oriented ETFs, or even a broader Canadian market ETF, because these are the stocks I want exposure to. But I don't want to have to buy a huge amount of an ETF or buy them on an individual basis to get them upper weighted in my portfolio. So I've been able to do that simply through an ETF, which I think is super, super cool. So before we talk about my TFSA and my RSP, I want to talk about just kind of the sector exposure weighting and what this kind of relates to with the NASDAQ. And I honestly think, Qs are probably one of the best investments you could make. I figure if the Qs ever crash enough again, I've been thinking about maybe playing some of the leveraged ETFs with it. I want to buy it back, but I keep reminding myself about the amount of exposure we already have to tech, again, with my fiance's portfolio in consideration. But when we look at the 5-year performance, obviously the Qs have absolutely crushed, with the exception of 2022, where it started to fall more in line with the performance of the S&P 500, and even some of these dividend ETFs, like the SCHD was actually outperforming even the Qs at a very moment we can see here for a brief amount of time. And I like getting a little bit more dividend income off these ETFs, because in these more secular, down periods, I'm able to invest a lot more money and reinvest more money, because growth is great until people aren't focused on growth, and then you have no income to cost average. So I always find a bit of balance of both really helps. But we can see that there's a bit of a separation here. VOO is represented by the blue line. The Qs is obviously the purple line. And then my two dividend ETFs like VDY and SCHD are a bit lower on the totem pole here. But over 5 years, the performance is much higher, because you have to take into consideration this doesn't show you dividends or dividends reinvested. So the performance of VDY and SCHD are far greater. And then at the very bottom here, we can see VNQ, which I'm looking at as being a recovery sector play. I think VNQ, a lot of people have been crapping on real estate, and I agree. I never wanted to own any of these kind of stocks up till the moment we could start recognizing that we're going to be on the turning point of interest rates, because something tells me, again, we should see outsized returns like we have in the past with other crashes, because real estate in the US is still going up in value. It's still hitting record highs. There's still supply and demand problems. Same with here in Canada. Canada's got a different real estate problem that's been going on, and because I own real estate in Toronto, I really don't want any more Canadian real estate exposure, which is why some of you asked me, why don't I buy or try and play the Canadian real estate ETFs? And it's for that reason. I don't want any more exposure to the Canadian economy than I have, especially Canadian real estate. So I'm very intrigued to see how these are going to overlap in the future. Tech is rather expensive, but it is justifying its growth in these earnings cycles. So like I said, I always want that tech exposure, but I'm glad it is the largest weighted positions in my portfolio today. So I want you to keep that in mind when you look at the totality of my portfolio, because again, people keep thinking just because I'm buying ETFs, I've given up on stocks and I just get the market weighted returns and blah, 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 blah. But I am owning a lot of individual stocks actually at the percentage weightings that make me sleep comfortably at night, and I get to do it through a very simple 4 ETF investment strategy. Now, again, I own crypto, I own small caps. We've talked about the small caps and even gold and precious metals. They're very small and comparable to some of these positions, even within the ETFs, but they're there, and some of them are actually performing exceptionally well. Gold's up a lot. Some of these small caps are crushing it. I just try not to look at them as often or share them with you in the totality of the portfolio, because I just don't believe over the long run, if they are super impactful, they're more lottery tickets than anything. So I don't want you guys to just think that I'm just investing in small caps, and it's, to me, it's a little bit more speculative, a little closer to the line of gambling. You shouldn't really be putting any more in there than you're willing to lose. Whereas things like VOO, over a 20-year period, the S&P 500 has never lost money. So these are kind of the ways that I want to represent myself, so that you guys are taking kind of the best decisions that I think most people should be making. Again, not as financial advice. And I also recommend you pay attention to how you invest in your own retirement accounts, right? Because taking on a lot of risk can detriment your future retirement, especially in these beautiful gems the government gives us. Like this is my TFSA, for example, where I make tax-free income in perpetuity for the rest of my life. And I like having this nice secular balance. I had some really good performance with Tesla in here. We took those gains, we diversified it into VDY, we bought some more VOO, and we recently just started buying VNQ, which I'm looking to scale to no more than about a 20K position for the time being, because that would set the weighting at about just over 5% of my portfolio, and I probably don't want much more than about a 5 to 6% weighting in real estate from a sector standpoint. It's just, again, continue to diversify and look for a little bit of inching of outperformance, hopefully led by the interest rate cuts. Now, I recognize that I'm going to have to pay withholding tax on the dividends from this ETF, but the way I look at it is because I'm getting over a 4% yield. I think it's about a 4.6% right now on VNQ. I'm going to lose probably about 0.7, because that'll be about 15% withholding. So I'll be coming in right in line at around a 4%, a 4% income off of it. And I'm fine with that, because if I decide to keep the ETF for the long run, I can draw those dividends out and use them 100% tax-free. So to pay 15% on one ETF and VOO, but VOO's dividend is fairly insignificant, and I primarily hold this more for growth than I do income, right? And that's where VDY comes in. VDY is purely for income. So it's just trying to find this nice little balance of everything in here. Whereas if you wanted to be more responsible, you should own VNQ and some of the higher yielding dividend US stocks or ETFs within your RRSP, because this beauty, obviously, it takes your income. It allows you to not pay any tax on your income. But once you put it in this tax sheltered account, you can get that tax back and then make tax-free income until you draw it out of this account. So basically, I can make all this US money, all these US dividends without withholding tax. That's the perk of the account, until I pull the money out. And once I start withdrawing the dividends, I will end up paying personal income tax on it, just not any withholding or any current tax while it grows. So there's kind of a little bit of amalgamation going on of just kind of playing with these tools and these rules and trying to build up my net worth in a very tax efficient way. And you might be thinking to yourself, Kyle, hey, I'm new to your channel. This money doesn't add up between your TFSA and your RSP. This doesn't equate to all this money you're showing me in these accounts. And that's because, I have over 100,000 in VOO sitting in my corporate account, where I tend to hold my more speculative plays as well. And the corporation comes into a whole nother field of discussions that I'm not going to get into within this video, but I just wanted to do a really kind of fun explainer and kind of give you guys this really broad view of my portfolio. It's yielding about 2.5% today. I'm hoping as I kind of inch up VNQ, we can kind of get this yield up to about 2.7% would be nice. Ideally, I'd like to be at 3%, but I don't think I'm going to be able to get there with the current holdings. It's always kind of been my dream. I feel like 3% is a nice balance of growth and income, but I'm not willing to fully sacrifice growth for that income, because I'm not a pure dividend oriented investor, as many of you are aware. I believe total returns matter more than just dividend income, and that's why I focus so heavily on ETFs these days, because again, conservative in nature. I don't want to lose money. I believe they're like little army guys that I'm sending out, and I hope they come back without wounds, right? And they come back and bring me great rewards. But I'll pass it off to you at this point. I'd love to know what you think about all of this in that comment section below.